Well, the market kicking off a shortened trading week with muted moves. The S&P 500 closing at a new all-time high, though, but it doesn't tell the whole story of what's happening below the surface. Taking a closer look at index volatility, when you compare it to the dispersion index, which focuses on individual stocks, it shows them trending in opposite directions. Joining us now is Ryan Detrick. He is Chief Market Strategist at the Carson Group. So, Ryan, what do you make of that interesting trading action? We were talking this morning about how the market, it's a bit of a paddling duck market, where it's calm right on the surface, but then underneath there's some chaos brewing.
Well, that's right. Thanks for having me back, and happy new all-time highs for the S&P 500. One of the more boring all-time highs I think we've seen in a long time. I mean, it's interesting because, yes, we're hitting all-time highs, and we're up 20% 2 years in a row. Then we look at, and Jared just shared some of these numbers here. On the year, all 11 sectors are higher on the S&P 500. 7, at least as of Friday. I don't know today's data, but as of Friday, 7 groups were actually outperforming the S&P 500. So I think what's interesting is we look at these sentiment polls, and people are a little leery. Believe me, the scary headlines. We had the big drop in tech a couple weeks ago on AI concerns, so the sentiment's a little dour because people are probably a little overweight technology. But I think to put a bow on this, the reality is under the surface that duck might be pedaling pretty fast, but it's a really strong bull market. It still looks healthy to us. Maybe you're due for a little consolidation. That's okay. But to see the broad participation that's taking place, it's a great sign. I mean, last thing on this, the lifeblood of a bull market is to pass the baton around, right? And we're seeing that. We're seeing that baton being passed around. There's a lot of leadership. There's a lot of positives still out there.
But it doesn't feel like it, right? Like, am I wrong in thinking, you said it today, this was one of the more boring records that we've seen. I was looking at the AAII sentiment, which bearishness highest since November 2023. And I know that can be a contrary indicator, Ryan, but it feels kind of meh right now to be seeing these all-time highs. Does that matter?
Well, I guess to someone, if they're investing, it maybe doesn't matter as much because, hey, all-time highs are all-time highs. But I'll build on that. Just about an hour ago, one of our Carson advisors reached out to me and said they've got clients that see the headlines. They see Trump might do this, or tariffs might do that, or taxes here and Fed there. And the headline risk is real. We're not ignoring the headline risk. A couple Mondays in a row, we know what happened with those big down days. But then you look back and we're earnings season, like you guys have been talking about all day. Earnings are really strong, all-time highs. But here's a really interesting one for you. During this earnings season, 8 of 11 sectors have seen profit margins also increasing. So you got strong profit margins, strong earnings, strong revenue. I mean, we can get more in the weeds of it, but that's why we're hitting all-time highs, and the headline risk is there, but it's nice and slow and almost kind of boring at these big blasts, like you said, Julie, of volatility on some down days, on some scary headlines. But, surprises in a bull market happen to the upside. I learned that a long time ago in my career. We're in a bull market, so maybe we shouldn't be that surprised. We keep chucking higher here.
You mentioned sectors, and year to date, all 11 sectors are in the green. Finally, we have this broadening trade happening, but it's still a very concentrated stock market. Valuations, particularly in tech, are still very high. At what point does that become a problem?
Well, I think a great question there. I mean, I think for tech, it maybe has become a problem. I mean, people don't realize this, I don't think. Last year, tech underperformed the S&P 500, not by a lot, just by a little bit. So far this year, tech once again is underperforming the S&P 500, but because that's where the pricey stocks are now. That's where a lot of growth is coming from. Let's be very clear. But how'd the Mag 7 do on the whole with earnings, right? They had tons of money, they made money, but the reactions were weak, right? So the bar was awfully high, but that's where, again, this rotation trade with financials doing well, with industrials. I know small and mid caps can be a dirty word sometimes, but they're starting to do very well. And just globally, right? We like the U.S. more than the rest of the globe. We've been saying that for 2 years. But all of a sudden, like Jared shared, I mean, you've got China coming back and Europe is really bouncing back. I mean, this broadening out theme is not just a U.S. thing. It is a global theme. And for diversified portfolios, those investors out there that have stayed tried and true to diversifying and rebalancing, you're really being rewarded because, again, tech might be coming back relative. That's not the end of the world. There's other groups that are doing well, and that's how bull markets work.
It's interesting that you bring up international stocks, too, because we were talking to Stephen Whiting from Citi at the top of the show, and he's not the first person to say this, nor are you. This has been this growing drumbeat lately that people should be looking outside the United States. But then how should people think about the tariff risk, the trade war risk, which we're thinking about a lot here, but obviously there could be a big effect elsewhere also?
No, you're right. And again, we have some international exposure. We're still overweight U.S. But I think the key concept here is the U.S. dollar. If the U.S. dollar breaks above the recent highs we had earlier this year, that's kind of all bets are off. The tariff concerns, whatever else is out there, the monster under the bed could be coming. But I know the dollar up a little bit today, but last week the dollar was down pretty big on the improving PPI data. We're of the camp, we're bullish, yes, over at equities, yes. We don't think there's going to be one cut this year. We think it's going to be more like 2 or 3. We think inflation is going to continue to improve, allow for the Fed to cut a little bit more than being priced in. That could allow that U.S. dollar to go lower. And let's be honest, look at history. A lower dollar is good for risk assets, but it's actually a little bit better for international stocks as well. A group that, again, we're underweight. We'd be fine if they go up, but we still think there's a lot of opportunity. One final thing to add to this, international small caps, mid caps, they're all kind of the same family. If we see some outperformance in those areas, we think small and mid caps also should do very well from the United States in the U.S. here, and we like those areas as well.
And I want to pick up on your projection of interest rate cuts between 2 to 3 times this year. Obviously, that's ahead of consensus, and you believe that we will continue to see a deceleration on the inflation side. But what about on the growth side of the story? Do you think tariffs will weigh on growth? Do you think we could see a deterioration in the U.S. economy or in the jobs market that could potentially force the Fed to cut?
Great question. If we get massive tariffs, absolutely. It absolutely could do that. But we're not seeing that yet. I mean, I know the retail sales data that came out last month was bad, but just go outside. It's really cold outside. I mean, we still see a strong labor market. We still see a strong job market. Productivity. What did we see, I think, 2 weeks ago now? A lot of jobs were revised lower, but GDP was actually revised higher. What's that tell us? Strong productivity. You go back and look in the history books, years with strong productivity tend to have better economic growth than expected, and usually the stock markets do really well. We've seen that for the last really 6 quarters now, strong productivity. So that's a big theme we have on the Carson team. Strong productivity is going to lead to this bull market continuing to be stronger. And maybe to get specific to your question, there's cracks out there with the economy. Yes, the higher interest rates clearly are hurting the housing market. Manufacturing starting to show a pulse finally after a while. But the consumer, I know, again, one bad data piece with the retail sales, but I think there was some issues there. If we see more than one, then I'll be worried. But the consumer is still pretty darn strong in our opinion.
Ryan, good to see you. Thank you.